Hello and welcome to the 29th lecture of the course Forex in 3 steps. We are now in the final section of the course, which is the advanced strategies section, where we will learn advanced technical analysis techniques that will help you in the markets and make you profitable trader. The first strategy we will talk about will be the Fibonacci strategy. The Fibonacci retracement strategy is a very simple strategy, especially to beginners. All beginners in trading usually start with the Fibonacci strategy because it is very simple. Let's open TradingView and get straight into it. So what is a Fibonacci? We all know that trends are usually happening in the financial markets, and markets usually trend to the upside, where we can identify it easily by just pulling a trend line and recognizing that the trend line is pointing to the upside. And same goes for a downtrend, where we can draw our trend line to the downside and it is clearly pointing to the downside. So after identifying a trend and realizing that price keeps breaking to the upside in a bullish trend, so for example here price is continuing to break to the upside, like here and here it is continuously breaking to the upside. And after a break, what happens? Usually after a break, just like we covered, usually a retracement happens and then price continues in the trend. Then after a break, usually price retraces and then it continues in a trend. So the Fibonacci retracement is very useful when you have a trending market and you know for a fact that we just broke bullishly and you are expecting price to pull back, but you do not know where price will pull back. In this scenario, you can pull your Fibonacci tool from the low to the high in a bullish trend, and vice versa in a bearish trend. We will cover it right now, but in a bullish trend you pull your Fibonacci from high to low, from low to high, and after you pull it from low to high, this is what you get. This is the Fibonacci tool. This is what it looks like. It is basically a tool that measures the distance between a low and the high and then tells you where price may come into and retrace to. So there is always the question, where will price retrace? Usually prices retrace to the Fibonacci levels. Of course, not any level. I will tell you the levels I have right now. So this is the Fibonacci tool settings I have. You can copy these settings, and basically all I have is the 0.618, the 0.665 and the 0.786 levels, and these are basically just percentage, just like you see here. The 61.8 is the 61.8%, 65% and the 78.6%. So basically they are measuring the distance between this low and this high, and they are telling me where the 78% is of this leg, and they are telling me where the 65% is and where the 61.8 is. Why do I need to know that? Because usually price retraces to one of these levels and then it moves back to the upside and continues the trend. And if I keep, you can also, for example, I can also use it here, for example, and price usually, you will find out that price usually hits this level and keeps going up, and then same here, and it keeps going, continuing the trend by retracing to the Fibonacci retracements. So how do we know which level it will come to? So many people can ask, so I have 3 levels, you have 3 levels, which one should I use? I usually tell them to use this as a zone. This is called the golden pocket or the golden zone, which is between the 61.8% and the 65%. This I treat it as a full zone, and I usually wait for price to come in and start breaking to the upside by making a double bottom, for example, or a head and shoulders, for example, by having a left shoulder ahead and a right shoulder, or either by making a bullish candle, for example. You can use whatever confirmation you need, but these are levels that if used alongside support and resistance, alongside short patterns, candlestick patterns, and other things we have covered throughout the course, you will find yourself entering very nice trades. And for the 78.6, this level is very popular as well, but this level is the more popular one, and people usually like to wait for the retracements. So for example, after this break, if we are in a bullish trend and we are continuing to the upside, people usually wait for this level to get hit, and then they look for confirmations and bullish momentum, and they enter from here for the other leg up, because the expectation is usually if a trend is strong enough and is continuing bullishly, then price is likely going to continue the trend and keep going up. And for the 78.6, same thing. You usually want to wait for a chart pattern or a candlestick pattern or whatever confirmation you need in order before you enter. These levels you should not just enter. So once again, for the bearish scenario, we realize that the trend is going very bearishly, very aggressively, and we keep on breaking to the downside. So what is the expectation now? Expectation is to make a retracement and then continue the trend, just like we did here. We retraced and then we continued the trend. So expectation is telling me that the same thing is likely to happen. And then how do I know where the retracement will go? I can use, this is where the Fibonacci retracement comes in handy. You can pull it from high to low, because this time we are in a bearish trend. So in a bearish trend, we pull it from high to low. In a bullish trend, we pull it from low to high. Make sure you're pulling the Fibonacci correctly so it doesn't give you wrong numbers and wrong percentages. Okay, that's very important. So after I pulled my Fibonacci, I've also added this time two new levels. One is the 0.382 and another is the 0.5%. These are also two kind of popular levels as well, but they are not as important and strong as these three. But sometimes when the market is volatile and when the market is aggressive, sometimes a retracement may not go as deep as expected, and it ends up going to the 38.2% and rejecting from there, or either hitting the 50% Fibonacci and rejecting from there. This is also very possible. It does not, retracements do not always have to reach your levels, your deeper levels, which are the 61.8, 65% and the 78.6 level. So do not expect to always have a deep retracement. Sometimes markets can even not retrace and they can just dump and then start continuing down and never reaching these levels again. So it is something to keep in mind. Again, the best zone is the 61.8 and the 65%, but that also doesn't mean price can break it, can't break it. Price can break it and reach the 78.6, and price can always decide to reverse the trend, which means that the trend has reversed. So keep that in mind as well. But using confirmations increases the likelihood of a trade happening. So if, for example, price retraces to the 38.2%, and then you find that we are creating a head and shoulders pattern, for example, then you can look for a trade because you have gotten extra confluence in this area. Same thing with all the areas, the 50%, the golden zone, or the 78.6 level. And that is basically it for Fibonacci's. Let's take a few examples that are live so you can understand how they work in real life. So here is a very nice example on the gold chart, on the 4-hour chart. You can see that price was in a bullish trend, and then price decided to start reversing the trend, and it reversed very aggressively to the downside. And then after it broke here, expectation was telling us that price is likely, since it broke bearishly, it is likely going to make a retracement to the upside and then fall even more aggressively and break again. So what happened here was price decided to break all the levels except for the 78.6 level, and this was also because there was a confluence here, there was a supply zone, and we will talk about supply and demand zones very soon, but this was also extra confluence. Plus we had if I go down onto the 15-minute, you will find a chart pattern that confirmed the trade, and you were able to identify where the retracement will land based on the 78.6 level. And as you can see, you could have entered from here after you've of course confirmed the trade by whatever entry method you'd like, and then price shoot down very aggressively, and this was a very successful trade. Another example here was here after price, if I go down to the 1 hour, I believe, if I go down to the 1 hour, you will find that price was able to break here bullishly. So if I draw the trend, it was of course very bearish, and if I draw structure, you will find that it was very bearish until we were able to break here. So after a break and the reversal of the trend, what do we expect? We expect a retracement to the downside to continue the new trend. Correct? Correct. So how do I know if we were here? How do I know where this retracement will land? Where will it land? I need to pull my Fibonacci tool, and then I will realize that price actually did not touch the 78.6 much, but it did kind of retrace between the 65 and the 78.6%, which is a zone I like to use usually, especially if the zone is small like here. But this was a nice example as well as to where and how to identify where the retracement will land. And you can pull Fibonacci retracements anywhere on the chart, to be honest. It's up to you how you want to use them and what time frame you'd like to use them on, but they are always nice to have and nice to use because they can measure and can tell you and forecast where a retracement may land. Because as I said, no market just goes up and no market goes down. All markets move in and up and down way, and markets are always retracing, as you can see here and here and here. These are all retracements, and the Fibonacci tool allows you to identify where the retracement will hit. And of course, after you confirm a trade, it is very nice when it bounces off one of these levels and you can enter a trade and have nice profits. And here is a last example on gold as well. This was very recent. So price basically was able to break very aggressively, and we were in a very aggressive uptrend, and after this break here, price was supposed to be retracing, because every time after a break, but not necessarily. So as you can see here, for example, when we retraced only a very short amount after this break. We did not retrace fully. So this is also very possible. But after we came here, and then we broke to the upside here, fortunately we got a retracement, and if I pull my Fibonacci retracement, I will find out that price kind of hit the 78.6 level and retraced from there. And of course, price does not have to hit a level exactly. These levels are not concrete. Price can move past them, price can front run them. It is always it's never this precise. It's never precise. Nothing is perfect in trading. Sometimes you may have a level and price comes and never touches the level, but it bounces off. This is also considered that price bounce off a level. So in this case, even though price moved through it, anyways you are looking for example, in this case we had a nice head and shoulders pattern. It was very beautiful. So we hit the 0.786 level, and then we built a shoulder, a left shoulder, a head, and a right shoulder, and then price moved on from there, as you can see. And until now, this trade was very successful by just knowing where the 78.6 level is and being able to pull it from low to high, and then price was able to go down very nicely. And actually you always need to pull your Fibonacci level from the low, especially in a bull run, in a bullish trend. You need to pull it from low to the highest point. So in this case, we do not pull it until here, we pull it until here, we pull it until this level, because this, when we pull it from here to here, this will recognize and be able to identify the real levels and the real percentages from this low to the highest high. Okay, you always need to pull it from the lowest low to the highest high to be able to identify where a retracement may happen. And in this case, it bounced off the 78.6, and we had a confirmation by having this head and shoulders pattern. And as soon as you saw this, you could have entered a long trade, especially after this break. This was very bullish, and this would have been a very high probability trade and a very profitable trade. And that is it for the Fibonacci retracements. Hope it all made sense, and we will still use it in other scenarios throughout the remaining lectures of the course, and I'll see you in the next lecture.